The largest silver collapse in 46 years happened in hours, but what happened in the physical market tells a completely different story. On January 30th of 2026, precious metals experienced one of the most dramatic price movements in recent history. Silver declined $51 in a single trading session. The price fell from $121 all the way down to $70. $51 disappeared within hours. This was not a gradual decline. This was a sharp, sudden collapse. It represents the largest single-day decline in silver since 1980, nearly 50 years ago. Financial analysts describe the movement as a Six Sigma event, a statistical designation referring to something occurring with extreme rarity. Global markets experienced substantial liquidation. Over $7 trillion in assets were wiped out across all markets in a 48-hour period. Retail traders faced forced liquidation through margin calls. Their accounts were being closed out in real time at the worst possible prices. Bullion dealers across multiple continents reported zero inventory. Shops from Dubai to Switzerland reported complete depletion of silver holdings. Amidst this global panic, one participant experienced a completely different outcome. This person remained calm. This person remained calculated. This person remained profitable. Nobody in mainstream financial media knows this individual's name. This person does not grant interviews. This person does not respond to media inquiries. This person operates from a small office in Gibraltar, far removed from major financial centers. Despite remaining anonymous, this person was holding the largest short position in silver on any exchange globally. The position consisted of 30,000 contracts representing 450 tons of physical silver equivalent. The profit from this single bet exceeded $288 million, according to Bloomberg reporting on February 5th. After accounting for previous losses, the net profit from the position reached approximately $144 million. This represents extraordinary profits from a single trade executed during market chaos. However, this story extends beyond one individual accumulating wealth during market turmoil. The events of January 30th, combined with subsequent developments on February 5th, revealed critical fractures within silver market structure. These fractures could fundamentally reshape how precious metals markets function. Additionally, trading volume data released from Shanghai on February 5th contains information that almost nobody in mainstream finance is discussing. This data potentially represents the single most significant commodity market data point currently available. By examining the identity of this mystery trader and understanding what actually transpired, the complete picture becomes clear. Every major financial news outlet shared similar headlines during that week. Silver crashes, gold declines, a specific Federal Reserve nomination shakes markets. However, mainstream reporting omitted crucial context. Silver futures on a major exchange dropped 31.4% in a single session. This represents the worst day since March 1980. Spot silver declined 28%. Gold dropped approximately 9%. Consider this ratio carefully. Silver fell 3 times harder than gold. If the decline resulted purely from dollar strength and interest rate expectations, why would silver collapse 3 times worse than gold? Both metals are priced in dollars. Both respond to identical macroeconomic forces, yet silver experienced obliteration while gold endured a difficult but manageable afternoon. This asymmetry reveals the actual story. The mainstream narrative describes straightforward cause and effect. A Federal Reserve Chair nomination occurred on January 30th. The market interpreted this nomination as signaling higher interest rates extending into the future. The dollar strengthened in response. Because precious metals prices are denominated in dollars, prices declined accordingly. Simple supply and demand of currency dynamics. Case concluded. This narrative is not incorrect. However, it represents only approximately 10% of the actual story. The remaining 90% explains why this moment ranks among the most significant silver market episodes since the Hunt brothers era of 1980. What actually occurred beneath surface appearances involved coordinated liquidation of leveraged positions combined with aggressive short selling. Data completely substantiates this analysis. Commitment of traders' data from the regulatory body showed speculative long positions in silver at near record levels preceding that week. The entire market was positioned extremely long. Everyone was leaning in one direction with greater conviction than almost any historical moment. Then the trigger arrived. A major investment bank's quantitative analysis team identified what they termed massive forced rebalancing in leveraged silver exchange-traded funds. One single silver fund experienced $3.5 billion of forced selling on January 30th alone. That represents enormous selling pressure from a single product in a single day. Subsequently, the major futures exchange raised margin requirements dramatically. Initial requirements were 11% of position value. New requirements jumped to 15%. During a selling collapse, this mechanically forces outcomes. When margin requirements increase during declining prices, leverage traders facing inability to meet new requirements face forced liquidation. Their positions get dumped into an already falling market. Prices crater further. Additional margin calls trigger. More forced liquidation cascades. A self-reinforcing death spiral develops. This represents the environment in which our anonymous trader positioned himself perfectly. The mystery trader's name is Beyond Shaming. Understanding this individual's history clarifies why his involvement in the silver crash reshapes the entire narrative. Beyond Shaming is a Chinese billionaire who accumulated over $3 billion in profits from long gold positions on Shanghai futures since 2022. This represents extraordinary success in commodity trading. He achieved $3 billion of gains over 4 years from a single direction. Yet simultaneously, he just earned hundreds of millions from betting against silver. Bloomberg reporting published February 5th documents Bian building short positions through his brokerage on Shanghai futures. Exchange data shows the brokerage's silver short position surged to 18,000 lots on January 28th, 2 days before the collapse. By January 30th, the exact moment silver reached all-time highs in Shanghai, his position had grown to approximately 28,000 lots. He added 10,000 more short contracts precisely when silver peaked. His total position reached approximately 30,000 contracts equivalent to 450 tons. Now, critical precision matters here. This analysis does not claim Bian caused the crash. No evidence supports claims he possessed advanced knowledge regarding the Federal Reserve nomination. What this analysis does claim is that an individual who generated $3 billion being correct about gold over 4 years made a massive directional bet against silver at precisely the right moment. The timing appears remarkably fortuitous. Bloomberg analysis of exchange data indicates he began building this position back in November 2025. He was attempting to catch the top. Early attempts generated losses. Interestingly, he previously held long silver positions. In August 2025, his long silver trades earned over 1.3 billion yuan. Therefore, he profited from silver rising. Subsequently, he completely reversed positions and profited from silver falling. My assessment after analyzing this situation extensively is that Bian simply read market conditions accurately. Silver experienced parabolic rally characteristics. It rose from approximately $30 in early 2025 to exceeding $121 by January 29th. A fourfold rally in under 12 months exhibits historically unsustainable dynamics regardless of underlying fundamentals. This pattern repeats regularly across commodity markets. When any asset quadruples in 12 months, leverage builds underneath, creating severe systemic risk. Bian recognized speculative excess. He observed dangerous leverage accumulation. He bet gravity would eventually overcome momentum. Gravity did. Yet one element genuinely troubles me. One individual trader operating through a single brokerage held the largest net short position on the entire Shanghai futures exchange. He manages personal accounts and select client portfolios simultaneously concentrated into identical positions. He profited massively while everyone else experienced destruction. Some analysts estimate total gains exceed $500 million. However, the physical silver market during this period revealed something far more disturbing than any single trader's profits. While paper silver crashed towards $70, completely different dynamics dominated the physical market. This represents information that caused me to fundamentally reassess everything regarding commodity market function. I have covered precious metals for years. I have observed disconnects. I have witnessed volatility. I have never witnessed anything comparable to what occurred on February 2nd. Data compiled by multiple analysts and confirmed through exchange pricing shows that identical silver ounces traded at vastly different prices depending on geographic location. In New York, silver traded at $80. In Japan, that same ounce commanded $120, 80 versus 120. Identical metal, same day, 50% price difference. The geographic divergence extended beyond Japan. Shanghai quoted $111, India quoted $93, Kuwait quoted $106, Dubai quoted $91 with a 15 to 18% premium above spot, Every single major global market priced silver completely differently. One analyst described this as the largest sustained precious metals price divergence in history. The same metal, the same ounce, the same element, 40% different prices depending which market you reference. Properly functioning markets should not display spreads this extreme for more than minutes. Arbitrage traders should purchase cheap in New York, transport to Shanghai, and close the gap. This did not occur. The reason, according to analysis published in financial literature, involves silver lease rates surging to 7 to 8%. Factoring in borrowing costs plus freight plus insurance eliminates arbitrage opportunity profitability. Moving metal west to east became economically impossible. The system designed to keep global prices aligned broke completely. The situation deteriorated further. Physical silver bars were completely unavailable in Dubai. Traders reported exhausted inventory, with buyers paying 2,000 dirhams per kilogram above market rates just to secure metal. One dealer stated silver was unavailable at any price. One major Swiss bullion dealer reported zero silver stock. Not depleted, not low, zero. Replenishment took weeks. When silver arrived from customer sales, it sold instantly. Nothing remained for new buyers. Gold inventory was nearly as bad. All coins and small bars were gone. Only large bars and specific weights remained. Connecting these observations reveals critical information. Paper markets say silver is worth $80. Physical markets say you cannot acquire it at $100. Dubai says nothing is available at any price. Switzerland says zero inventory exists. Meanwhile, the paper to physical ratio is estimated at 350 to 1. For every ounce of physical silver, 350 paper claims exist. That mathematically cannot sustain itself. What happened next made these numbers even worse. February 5th revealed extraordinary information that almost nobody covers. Shanghai Futures Exchange data shows that 1.4 billion contracts were traded in a single morning on April silver contracts. Each contract represents 15 kilograms. That morning session alone represented approximately 674 million ounces in equivalent physical silver. Adding all silver contracts from that morning brings the total to approximately 1.34 billion ounces. Consider this number carefully. The entire world mines roughly 800 to 850 million ounces annually. One morning on one exchange represented nearly double annual global mining supply. When I initially encountered this number, disbelief followed. I verified the contract specifications myself. The mathematics checks out repeatedly. One analyst termed it the most remarkable event in commodity market history. This was not retail traders acting impulsively. This was enormous deliberate short selling designed to crash Shanghai silver prices. Remarkably, even after 1.34 billion paper ounces were dumped on the market, Shanghai silver closed at significant premiums to Western prices. Paper was beaten down. Physical premiums survived intact. Shanghai silver remained above 120, while Western prices neared 70. The Shanghai premium returned to $17 per ounce immediately. Silver maintained backwardation, meaning near-term delivery cost more than future delivery. This signals physical tightness no paper selling can overcome. Paper games cannot break physical reality. That observation crystallized my entire analysis. You can dump years of global production onto a market in one morning and physical premiums still refuse to collapse. That tells you where true market power resides. Not with paper traders, with whoever holds actual metal. Shanghai Futures Exchange physical silver inventory declined sharply. January levels showed 482 tons, February 3rd showed 449 tons, February 4th showed 423 tons. That represents 26 tons lost in a single day. For context, Shanghai inventory peaked above 391 tons in January 2021. Current levels of 423 tons reflect 86% decline from that peak. Silver physically leaves warehouses continuously. This is actual metal, not paper trading activity. China's industrial demand for solar panels, electronics, and high-tech manufacturing consumes metal faster than replacement. The January 30th crash presents paradox. Headline analysis suggests silver is finished. Bubble burst, story concluded. However, fundamentals scream opposite conclusions. This situation differs from anything I have observed in my commodities career. On January 1st of 2026, the Chinese government officially reclassified silver as a strategic resource. Only 44 companies received authorization to export silver for 2026 and 2027. This covers approximately 121 million ounces of annual exports, representing 60 to 70% of globally refined silver supply. China controls the world's largest refinery system. They just placed governmental control over supply leaving their country. Governments do not reclassify commodities as strategic unless they intend internal retention. I have discussed this on my channel repeatedly. When governments begin hoarding commodities and restricting exports, that provides the clearest possible signal about where they believe value is heading. Furthermore, Samsung, one of the world's largest technology companies, secured 100% of output from a major Mexican silver mine for the next 2 years through a $7 million prepayment agreement. Samsung did not purchase paper silver. They bypassed the entire exchange system and went directly to the source, demanding every ounce produced. When corporations of Samsung's magnitude bypass exchanges entirely and contract directly with miners, that reveals everything about what sophisticated industrial buyers think regarding future silver availability. They do not trust paper markets to deliver actual metal. Smart money no longer participates in paper markets. Smart money acquires physical supply directly. A government is hoarding silver. A mega corporation is locking up entire mine production. Nobody trusts exchanges to deliver actual metal. If that does not force reconsideration of market structure, nothing will. The timeline problem that mainstream finance refuses discussing. New silver mining projects require 7 to 10 years for completion. Supply response to current demand will not arrive until 2033 at earliest. The supply curve is locked for the next decade. Meanwhile, silver has been in structural deficit for 6 consecutive years. The deficit expands every year, not contracts. Solar panel demand alone consumed over 200 million ounces last year. Electric vehicles, artificial intelligence, data centers, 5G infrastructure, medical devices all require silver. No substitute exists. You cannot substitute material from solar panels. Physics does not allow it. Even the state of Wyoming announced physical precious metals vaulting for state holdings. United States state governments are now actively securing physical gold and silver storage within borders. When state governments vault precious metals, that is not a normal signal. That indicates fundamental institutional perspective shifts. My honest assessment, January 30th collapse was a leverage event, not a fundamental event. Leverage events mean price moved due to positioning, not true value. Physical market data completely confirms this. Physical silver in Shanghai held above 100 despite worse conditions. Physical silver in Dubai was unavailable. Physical silver in Switzerland literally did not exist. Paper price, $80. Physical market, you cannot acquire it at 100. That is not bear market. That is broken pricing. Fundamentals behind physical tightness have strengthened since crash, not weakened. Silver is in structural deficit with 7 to 10-year supply lock. China restricted exports January 1st. Industrial demand accelerates quarterly. COMEX inventory lost 26% in 7 days. London inventory down 40% since 2021. Silver lease rates exploded from 0.5% to 8%. That is not bubble popping. That is genuine physical shortage while paper markets pretend nothing is wrong. Goldman Sachs targets 5,400 gold. Bank of America floated 6,300. JP Morgan forecasts 6,300. Silver historically does not stay at 55-to-1 ratio when gold is in secular bull market. If gold reaches 6,000 and ratio compresses to 45-to-1, silver reaches $133 to $150. My view, we are witnessing one of the most asymmetric commodity setups ever. Risk-reward for patient physical holders vastly exceeds risk-reward for leverage paper traders. Paper can manipulate short-term. Paper cannot create physical ounces. Eventually, always, physical reality wins. Paper says 77. Physical says you cannot have it at 100. One is lying. History shows that eventually paper tells truth. This is Alex Silverman. Thank you for examining complete market structure.